My name's Tony Watson. I work for Robert Hall and Associates. We are a full service consulting firm based out of the Southern California area, Glendale area, Southern California. We are the go-to real estate and small business tax professionals here in the Southern California region. And we've been doing this, gosh, for going on 50 years now. I myself have been with the firm for 17 years, but Bob Hall has been doing this since 1971. And one of the more important topics that we cover in our webinars is the power of Inc. and how to utilize entity structures to save tax and to also protect assets along the way. So today's topic, tax savings during times of economic uncertainty and economic recovery. Hopefully we are on the tail end of this pandemic as we start to open back up, and even under the new mandates and whatnot, hopefully business can get back to whatever the new norm of business as usual will be. But as we progress into the end of 2021 and into 2022, we will start to see a little bit more planning done on the business side, especially from the asset protection side of business operations. And there probably is no better way, except for having a finely tuned insurance policy. There really is no better way or greater way to protect your business than to have it set up or rental property set up under an entity structure, such as an LLC or an S-Corp or a C-Corporation, but we're going to talk about that today. So once again, my name is Tony Watson. I've been doing this for 17 years. I'm not only an enrolled agent practicing actual tax preparation services and providing tax preparation services, but also I am the public speaker for our firm. Right now, currently, just my clientele alone, this number is a little out of date. I think just in my client roster alone, roughly about 350 million in annual real estate dealings, obviously on a year-to-year basis. I am also the keynote speaker for our firm, speaking at over 140 plus events across the US from the beginning of the year to the end of the year. Most of our educational webinars are held during tax season and during year-end planning season. But I'll tell you that the free education that we provide our clients and our potential clients, it is incredibly valuable, and we don't charge for it. It's all just essentially free education for anybody who wants to tune in and listen. We do offer free consultations. So at the end of the day, if you are looking to switch tax preparation firms and you need to sit down and kind of interview a tax advisor to see if they're the right fit for you and your business, we do offer free 30-minute, normally in person. Because of the pandemic, we've had to switch everything to digital platform for the time being. But once again, hopefully we'll be back up and running for in-person appointments. But FaceTime, Skype, email, fax, if you're still faxing things these days, and phone call, we can get those answers to you and provide that free consultation. So the biggest question today is incorporating right for you? One thing just straight out the gate I want to mention is that incorporating is not right for everyone, okay? Incorporating is right in very specific and unique situations, but for the most part, if you haven't bought your first property, if you haven't even started the business yet, but you're thinking about the proper way to hit the ground running in this new business venture, incorporating should actually be something that you sort of wait to do, because you don't want to tie yourself up with a bunch of unnecessary costs in the startup phases of your business. So is incorporating right for you? That is a great question. We call it, or I call it at my firm, the interview process. I have to sit down with a client and ask them 3 very specific questions to determine whether or not incorporating is right for them. Number 1, do you own personal assets? Do you own the home that you live in? Do you own a retirement plan? Do you have inheritance? Do you have any stock or brokerage accounts? Those are all personal assets. They're tied to your primary social security number, and therefore separating your business from everything that you own personally might be worth it from an asset protection standpoint. And that's exactly what incorporating does. It assigns your property or your business its own identification number aside from your social security number. So asset separation equals asset protection and vice versa. So question 1 is, do you own any personal assets? Question 2 is, what is the consistency of your net revenue going to be on a year-to-year basis? The consistency in net revenue is important because we want to figure out, okay, do I receive the asset protection benefit? And am I also going to receive some sort of financial or tax break benefit from incorporating? At about $45,000 to $50,000 in self-employed net revenue, it does make sense at that point to at least entertain the conversation of incorporating. Whether or not you take that next step to incorporate is really based on the advice from your licensed advisor, or whether or not timing is right for you. Timing is everything with incorporating. And so if you had a great year this year because of an unforeseen event like a pandemic, which caused your revenue to spike, but it's not a very consistent level of income for you as a self-employed individual, incorporating might not be right for you. But if this type of income or this level of income is consistent 2 or more years running, then incorporating might actually end up saving you tax as well. And we'll dive more into detail in a couple slides here. So question 2 is about net revenue. Question 3, normally we don't even get to question 3 because we can answer this overall incorporating question in Q1 and Q2. But by question 3, we're talking about risk and liability. What kind of level do you operate at as far as risk and liability is concerned in your industry? Let me give you an example. A realtor has risk and liability in what they do. They have E&O insurance, they have malpractice insurance, they have liability, they have all of their insurance policies there and in place. But unlike a skydiving instructing business, which it doesn't matter what you have in the contract, it doesn't matter what you have going on in all of the other aspects of your business. At the end of the day, you're jumping out of an airplane with a human body attached to your chest, right? So a skydiving instructing business will tend to have a much higher risk and liability in that specific industry than, compared to the real estate industry or a consulting industry of some sort. So question 3 is, what kind of risk and liability do you operate at? And in that example, the skydiving instructing business may incorporate, whether Q1 or Q2 is answered yes or not, they might incorporate just to protect themselves moving forward in case, heaven forbid, anything happens. So you have to sit down and go over these questions and have this conversation with a licensed advisor to make sure that incorporating is right for you. Just because your neighbor, your coworker, your family member, your friend, just because they incorporated and received a benefit for it, doesn't necessarily mean that you are going to incorporate for the same reason or receive the same benefit. So which structure is right for you? Or, we're going to talk about the LLCs, the S Corps, the C corporations. But first and foremost, for some of you who are listening in today, you might think, well, if I have a good insurance policy, would I really need an entity structure? And I want to make sure that we all understand that these two things are completely separate from each other, meaning that insurance is there and in place to pay out a settlement in case an unforeseen event happens. We don't know that we're going to be pulling out of a parking lot and be sideswiped by a drunk driver, right? So we have insurance to fix our car and they have insurance to fix their car, however that works out. We have liability insurance, we have malpractice insurance, we have E&O insurance, we have all of these insurance policies to protect us in case an unforeseen event happens. It actually has a dollar value as far as a payout is concerned. Whereas an entity structure doesn't have a payout value. An entity merely separates business and personal assets from each other. It assigns your business its own identification number separate from your primary social security number. And so in theory, you don't technically own the business or the property anymore. The EIN number of your business, the actual business name, owns that asset. And you individually are separate from that business. You are connected from a payroll perspective, or maybe from a flow through what's called a K-1 form, connection. But as far as asset separation is concerned, this is really the only way to truly separate business assets for legal purposes. So just make sure that you could have all the insurance in the world, but at the end of the day, if your social security number is still attached to all of these business assets and somebody sues you individually, they could technically come after everything that is registered to your social security number. That's a value, that they would want to come after. So asset separation equals asset protection. And the most popular entity structure, in the 17 years that I've done taxes and assisted with incorporating businesses, I'd say the most popular entity would be the limited liability company. Now, LLC stands for limited liability company, not limited liability corporation. I want to make sure that that is something that we take away from this slide here, because I've talked to many people over the years. I've been doing this 17 years. I've done, I think over 1,000 webinars now since first starting with our marketing department about 10 or 11 years ago. And most people think that an LLC files articles of incorporation. And so they think that it is, oh yeah, I'm incorporated, I'm an LLC, when in fact, an LLC does not file articles of incorporation. An LLC files articles of organization. And an LLC is not owned by shares, it's owned by percent. So when I own 100% of an asset that's held in an LLC, I don't own 100% of the shares of the business. I own truly a percentage of the business, which in this case is 100%. And the reason why I'm making a big deal out of the percent versus the shares, I'll come full circle with why that is the case here, or why I'm trying to make a point here. And it's because the LLC really doesn't provide any major tax benefit. It does allow you to contribute property, to distribute property, to contribute capital, to distribute capital, to share ownership with other partners, free from having any sort of major tax implication or tax liability. So if I go out and I buy a $500,000 property, I quit claim the deed into an LLC, I am not trading that $500,000 property for shares of a business. I'm merely capitalizing the business with a $500,000 asset. And once again, this will all make sense in a slide or two here. But LLCs, once again, don't provide any income tax benefit. They only provide great limited liability protection on large depreciable assets most of the time. For business owners who don't own assets, like a realtor who earns commission income, that's all self-employed revenue, and then they have expenses to reduce all of the income. Because it doesn't own any assets, a self-employed business like a realtor business might incorporate as an LLC for great limited liability protection, but may, after a conversation with their tax advisor, may elect for the LLC to be taxed as a different type of entity. Because if the LLC is not going to save you any tax, why would you stay filing as an LLC? What if we could have the best of both worlds? What if we could have the great liability protection of an LLC, but all of the tax breaks and the tax benefits of maybe a subchapter S corporation? And so the LLC doesn't necessarily have to stay as an LLC. If it makes sense from an income tax perspective, we can convert the LLC into an S corporation. Now, one thing that I do want to make sure that we all understand before I move on to the S corporation is that LLCs, like I mentioned just a couple seconds ago, they're great for protecting large depreciable assets. So rental properties should only really ever belong or go into an LLC. And there's one main reason from an income tax perspective why this should be the case. Rental income, if you buy a rental property and you're renting it out and you have your expenses and then you've got some net profit at the end of the day or some cash flow, when you go to pay tax on that rental property income, you only ever have to pay federal income tax and state income tax. You don't ever have to pay Social Security and Medicare tax on rental income. That's one of the beautiful things about rental investments. So you only ever have to settle up with the federal government and whatever state you file in. And if you live in a state that doesn't have state income tax, that's a big win for you. With self-employed income, so if you're a realtor and you're generating self-employed commission income, you pay federal tax, state income tax, and then you pay this nasty self-employment tax, which alone is 15.3%. And that self-employment tax is you contributing as a self-employed individual to Social Security and Medicare. Unlike a W-2 wage earner who already has it taken out of their paycheck, right? You get a paycheck, a payroll paycheck, and you receive a W-2, you automatically have to pay Social Security, Medicare, state disability, unemployment insurance, employment training tax before you even get the check deposited into your account. That is the W-2 wage side of things. If you're self-employed, you still have to contribute to Social Security and Medicare, except it's not your payroll tax anymore. It's just you contributing at the end of each year or on a quarterly basis to pay for your obligation to all of these social pots that the government expects us to eventually collect from. So an LLC, whether you're a rental property owner or a self-employed individual, won't save you any tax. Rental income, because it doesn't pay self-employment tax, it's great for protection. The LLC is great for protecting that large depreciable asset. But if you're self-employed and you have that self-employed earning income as once again, an example would be a realtor, why would you ever want to put your federal, state, and self-employed taxable income into an entity that doesn't actually save you tax? So the realtor, at the end of the day, starts the LLC thinking that, oh, it's going to save me a bunch of tax. But when they come and talk to their tax professional, we flip them from an LLC into a subchapter S corporation. And it's not two separate entities. It's literally a 3-page form that's filed with the federal government that says to the IRS, hey, I am not going to file as an LLC anymore. I'm going to file as a subchapter S corporation. It's just a conversion of LLC to S corporation. But on the state side, for instance, you are still, for liability protection purposes, an LLC. So you get the best of both worlds. Now you are converting your business into an entity that is, in fact, the only entity that can save you tax, while still achieving great limited liability protection on the state side and all of your assets that you own in that state. Now, how the heck does the subchapter S corporation save you tax? Well, pretty straightforward as far as tax savings is concerned. The subchapter S corporation is not going to save you federal tax or state income tax, but what it will help you reduce is that nasty 15.3% of self-employment tax. So just for ease of calculation, I've thrown up an example on the screen here. Let's assume that your business, after all expenses are taken into account, is generating $100,000 in net profit. Okay, this is after your mileage, your cell phone, your online charges, your office rent, your furniture purchase, your equipment. I mean, I'm talking about everything. And let's assume that just for ease of calculation, let's assume that your net revenue is 100 grand. Now that you are no longer a sole proprietor or an LLC, once again, sole proprietors, LLCs, they pay the same tax rate. Now that you are an S corporation, you are technically no longer self-employed. You are required to be an employee of your own corporation, and employees receive W-2 payroll, which can be as low as 40% of your net income. So in this case, 100 grand is your net revenue. You pay yourself a 40% reasonable salary, which is your W-2. So 40 grand is now your W-2. And then you as the business owner, as this S corporation, get to write off your payrolled employees, which happens to be you. So 100 grand minus 40,000 leaves you with flow through profit, or leftover profit in this case, of $60,000. Now, why the heck would you want to go through all of these, these steps to pay yourself a salary and then have net profit over and file 2 tax returns? Well, in this scenario, what you've done is you've split your 100 grand profit into 2 numbers where only one number is subject to federal, state, and self-employment tax. All numbers are subject to federal and state income tax, but there's only one number in this scenario now that is subject to that nasty 15.3% of Social Security Medicare tax. And it's not called self-employment tax anymore. It's called payroll tax. And that amount is only taxable on the 40 grand W-2 that you issued yourself. So on $60,000 you have avoided, remember, tax avoidance is illegal, tax evasion is not. So we are properly avoiding 15.3% Social Security Medicare tax on $60,000 of your company's profit. That calculates out to be just shy of about 10 grand, I believe, in overall tax that you're saving. And that's only on about 100 grand of profit. So let's break this down further. Left-hand column, if you're a sole proprietor LLC, you're paying max tax rates across the board because there is no tax benefit to being a sole proprietor. There is no tax break or tax benefit to being an LLC. But as an S corporation, you can see, once again, doesn't matter how you split the 100 grand, federal and state income tax stay the exact same. But look what happens to your self-employment tax. It drops from $15,300 down to about $6,100 if you pay yourself that reasonable salary, which overall yields a Social Security Medicare tax savings of about $9,180. Earlier in the first slide, I had mentioned that question 2 was about net profit. And I said, it only really makes sense to incorporate your business if your net revenue is consistently at 45 to roughly 50 grand of net profit. Well, look at the very bottom. 50 grand still yields a net profit or net tax savings of about $4,600. So the next question you probably have is, okay, well, how much does all of this cost me? I have to run payroll. I have to file 2 tax returns. I have to do consulting work before the end of the year. Industry average to operate a corporation, at least here in the state of California, is about $2,200 to $2,500 per year. That's including California's miscellaneous $800 filing fee. In other states, it could be a heck of a lot less. So you figure that at 50 grand of net profit, if it's costing you about 2 grand, let's say, to file as a corporation, but it's saving you $4,600 in overall tax, not only did you save enough tax to cover the tax preparation fee and the payroll fees and everything else, but you've actually made money in the process. You've actually been able to retain some of the wealth that you've built yourself over the past 365 days. So keep this in mind. Incorporating is not right for everyone, but if the numbers make sense, and from an asset protection, if the legal side makes sense, do not waste time in incorporating yourself. Incorporating is not just for the eBays and the Starbucks and the Googles of the world. Incorporating is for businesses with net profit as low as roughly $50,000, but it has to be consistent. It can't be a one-off year where you had a great year, but normally you're just at a break-even scenario. So just keep that in mind for future purposes. One question I've been getting a lot, over the phone lines as of late is coming out of 2020 because everybody was forced to work from home. Uh, is the in-home office still going to have a very high risk for audit under the current IRC and future IRC? Well, I professionally, I know that the in-home office will always continue to have a higher risk for audit because it's not really the deduction that gets audited. Yes, it's the form in theory that the government questions, but it's not the legitimacy of the deduction. It's the reasonable allocation of square footage that the taxpayer is using. Because remember that there's a whole 2, 3, 4 page part of the Internal Revenue Code that states that in-home office deductions are ordinary, necessary, and legitimate. But what gets people in trouble with the in-home office is above and beyond those three requirements, the ordinary, necessary, and legitimacy of the write-off, you have to make sure that you're being reasonable with the square footage allocation that you're deducting. Some people try to write off 40, 50% of their home as an office space. And at that point, the government might call your bluff. And this happens to be one of the only deductions the government can still come to your house to verify. Aside from payroll tax audits, if you're a large payroll company or if you have a lot of salaried employees, the IRS can still come and verify that those employees actually do work for your company. But the in-home office deduction is based on square footage of your primary residence. And so the government can still come and measure to make sure that you're being reasonable with the allocation. That's why it's really unique when you incorporate yourself. You actually no longer file an in-home office form as a corporation. You actually pay yourself rent out of your corporation to rent back the space inside of your house to your business. And so therefore, you're not filing this highly audited, what's called a Form 8829 form. That's the in-home office deduction form. It has close to a 70 to 75% chance for audit each year. You no longer are filing that as a corporation. You're filing a Schedule E, which is a rental property. So if you have a 12 by 12 room inside of your house that is office space, and you're incorporated, you would cut yourself a check every month to rent back the 12 by 12 room to your corporation. And therefore, you no longer file the highly audited form. You file a Schedule E, which has less than probably a 2% chance for audit. And at that point, you get to offset the rental income with mortgage interest, property taxes, insurance, improvements, and then also depreciation on the property. So just be aware that the game changes a lot when you incorporate, not only from a self-employed tax side of the equation, but also from the in-home office deduction side of things. So, if there's pistons firing right now in your brain thinking, wow, I've been missing out on a lot of these benefits, do not hesitate. If you've been hitting this stride and you've been making 45, 50 grand in net revenue for some time now, you definitely want to sit down with your tax advisor and make sure that if now is the time to incorporate, that you go ahead and do that, especially as we encroach on the fourth quarter of 2020. 2021, I'm sorry. In 2022, nothing will change for the S corporation. Some of the Green Book has talked about changing the tax rate for C corporations, but at the end of the day, the Green Book hasn't really discussed anything as far as changes are concerned to the 1120 S corporation. So all of these benefits that we've talked about, they should be sticking around for a pretty long time. They've been around since the early 70s. So just be aware that this is a benefit that you may be able to take advantage of. Coming out of 2018 for business owners is something called the Qualified Business Income Deduction. And this essentially, it means that if you are married filing joint, or if you're married filing separate, single, or head of household, you can follow the right-hand column. For married filing joint, you're going to follow the left-hand column. If you are self-employed, you have what's called qualified business income. And if you are married filing joint and your taxable income is under $326,600, or if you're single head of household, married filing separate, and you're below $163,000 in taxable income, you would qualify for the full QBI deduction. Which, what does QBI mean? QBI is not a venereal disease. It stands for qualified business income. And it means that if you are below one of these two thresholds, you qualify for a 20% credit against your qualified business income, meaning that if you have $300,000 of qualified business income, all self-employed net revenue amounts, and you're married filing joint, the first $60,000 of your $300,000 QBI amount is tax-free. That is $60,000 of your income that does not pay a single dime of federal tax. Now, this is all great on the federal side, the states have not conformed to the QBI deduction. So just understand that this is a massive credit on the IRS return, nothing credited on the state return. So just be aware of that. And that 60 grand, let's say you're in the 25% bracket, that 60 grand of non-taxable income just saved you about 14.5 in overall tax liability. It literally saved you $14,000, I think $400 in income tax. And so the reason why this is really important to understand, especially moving forward into the end of year planning quarter, because we're doing a lot of year end planning in the fourth quarter this year, we need to figure out creative ways for business owners to drop themselves below these qualified thresholds. I mean, think about it. If you're sitting at about 400 grand in overall taxable income, married filing joint, and you have the ability to go out and max out a 401k, profit sharing plan, IRA, go out and buy a company vehicle and accelerate the depreciation on the vehicle, and effectively drop yourself from 400 grand below $326,600, this would not only allow you to reinvest money back into your business, funding a bunch of money into your retirement plan, acquiring new company assets, but also qualifying you for 20% of your qualified business income to be tax-free, literally tax-free. You don't pay a single dime of federal tax on that 20%. And obviously, if you're well above the phase-out threshold of $426,600 or $213,300, if you're single, head of household, or married filing separate, then there's a little bit more of a game that you need to play. You need to definitely sit down before the end of the year and figure out ways to reduce your taxable income by reinvesting profits back into infrastructure. But this is a massive credit for the self-employed world, not only on the cash flow side from rental investments, but also the self-employed earners, the realtors, the online consultants, the 1099 contractors of the world. This means, because you're getting paid self-employed revenue, that you are a qualified business income earner, and therefore you can qualify for this benefit. You just have to plan ahead. One phrase that goes really well with the tax industry is failing to plan is ultimately planning to fail. That is something that should ring out in your mind at the end of the third quarter every single year. You need to put aside some time in the fourth quarter of each year to sit down with your tax advisor, figure out creative ways to retain more of your wealth. Not really to do tax planning, right? I don't like calling it tax planning. I like calling it wealth retention planning, because the less tax you pay, the more you get to keep, right? That's you just have to turn on that switch and start thinking a little differently and figure that every dollar in tax that I save is a dollar I retain of my hard-earned wealth. So keep that in mind. Obviously, we've covered a lot today. We offer a number of services at Robert Hall & Associates. We do tax preparation. That's our main service, but we also incorporate businesses. We do bookkeeping. We have payroll services, financial planning, estate planning. We've been around since 1971, and we're kind of a powerhouse here in the Southern California area, but we work mainly and specifically with rental property investors and self-employed individuals. That is probably 90% of our clientele. And those are the individuals who we can help the most. Anyone who has rental cash flow, self-employed revenue, and the ability to incorporate just adds fuel to that fire in a good way. So keep that in mind. And once again, we do offer free consultations. A lot of people use this free consultation for us to review 2 years of tax filings, figure out if there's any red flags or triggers on those tax filings. And if we need to go back and amend anything, we will go ahead and do that. But at the end of the day, it's a free consultation. And so once again, we'll review 2 years of tax returns, check for any possible audit triggers, and then also add you to our periodic tax email update, which will let you know about our upcoming free educational webinars. And hopefully you'll be able to log in and learn a little bit about some other topics that I speak on: year-end planning, buy low, sell high is a good real estate webinar. I do the power of Inc. We do estate planning and trust planning webinars, and we have guest speakers and panels and whatnot. And all of our education is free. So that's one of the big bangs for your buck there, is that you don't have to pay for any of it, which is great. So I'll go ahead and leave this up on the screen. I don't know if there's any questions that anyone has. Consultation. You can go ahead and text the word Robert Hall to the number 72,000, or take your smartphone device and wave it over that QR code, and it prompts you to sign up for that free consultation.